Welcome to Topics in Digital Economics. This video is about the impact that information on prices has on the market structure. In the presentation, we follow a very simplified market setting. It's a duopoly. We've got two firms, call them 1 and 2. They produce the same product, exactly the same product at the same marginal cost, which we symbolize by the letter C and set equal to 20. We've got 1,000 potential consumers. They are all the same. They consume at most 1 unit of the product. Think of the product being a fridge. You buy the fridge or you don't buy it, but you don't have any utility for a second one. And they're all the same. They've got a reservation price of 100. That's the maximum price they're willing to pay for a fridge. If the price is above 100, nobody buys. If the price is below, they all buy. Now, the two firms will simultaneously set the price of the product, and these prices are symbolized by P1 for firm 1 and P2 for firm 2. Now, we look at two scenarios. In the first scenario, we assume that buyers may have some imperfect information on the prices, so they may not be able to observe all prices, and we want to see what impact that has on the market performance. And then we do the same by assuming that it's now the sellers who may have trouble in observing the price of the other firm. Let us start with scenario 1, imperfect information on the buyer side. As a benchmark, let us assume that all consumers are informed in the sense that they all observe the two prices. In that case, because the products are exactly the same, consumers buy where it is the cheapest. If P1 is lower than P2, all consumers will buy from firm 1. If P2 is lower than P1, all consumers buy from firm 2. And if the two prices are exactly the same, then we assume that half of the consumers, 500, buy from each firm. We also assume, this is important, that firms have a sufficiently large capacity to serve all the 1,000 consumers. Now, this is a model that you probably already know. This is called the Bertrand model, due to Joseph Louis François Bertrand, a French economist. And you remember that the unique Nash equilibrium in that model is such that both firms set a price equal to the marginal cost. P1 is equal to P2 is equal to C is equal to 20. So the intuition is quite simple to grasp here, in the sense that because as soon as you're cheaper than the rival, you can attract all the consumers, each firm has an incentive to undercut the rival, to set a price just below the price of the rival. And if you go on with this process of undercutting, you reach a point where both firms can no longer decrease their price, and this is the unique Nash equilibrium that we have here. Both firms set a price equal to the marginal cost. You can check in this table that all the other situations are such that at least one firm has an incentive to set a different price, to deviate in order to increase its profit, and because of that, these situations cannot be Nash equilibria. Okay, so we recall here that because firms are setting prices simultaneously and sell exactly the same product, and because consumers can observe the two prices, then competition becomes extremely strong, and as a result, consumers can buy the product at marginal cost, so their consumer surplus is maximized, but the firms makes no profit, no economic profit in this case. So that's the best possible scenario you can think of if you are a consumer. We now assume that all consumers are uninformed, in the sense that they can only observe a single price. So say that 500 consumers, half of them only observe P1, and the other 500 consumers only observe P2. So you can think of consumers being located near a shop. There are 500 consumers near shop 1 and 500 consumers near shop 2. They know the price of the shop they are located near to without any cost, but they have to pay a cost, and we call this search cost, and we equate it to 2. They need to pay a search cost if they want to learn the price of the other firm. This model is due to Peter Diamond and was produced in 1971. Okay, so we want to know how firms are going to set their prices in that setting. But to predict the equilibrium, we need to impose an additional requirement, which is that consumers have rational expectations. Why do expectations matter here? Because consumers, when they decide to incur the search cost, they do this on the basis of what they expect the unknown price is. So, to be clear, a consumer must expect that the price it's going to find is lower by more than 2 if it wants to decide to pay the cost of 2. So it's only worth searching for a price that is sufficiently lower than the price that you already observe. Okay. Now, based on that, we can see, first of all, that the previous equilibrium, where prices were equal to marginal cost, is no longer an equilibrium. Well, suppose that firm 2 sets a price equal to 20. And now take the point of view of firm 1. Well, firm 1 knows that its captive consumers, the 500 consumers that only know its price, these consumers will search for the price of firm 2 only if they expect that the difference between P1 and P2 is larger than 2. Okay, so that allows firm 1 to raise its price up to a little bit less than 22. Okay, at that price, its consumers know that it's not worth trying to discover the price of firm 2 because that price cannot be lower than 20 anyway. They know that firm 2 is not going to set a price below its marginal cost. Okay, so firm 1 can safely raise its price above 20, but below 22, keep its captive consumers, and now make a profit of about 100, which is above 0. So there is no reason to keep P1 at 20. Okay, there is no risk of undercutting here in a sense, because firm 2 cannot gain anything by setting a price below 20, and it cannot attract the captive consumers of firm 1 if the price difference is not larger than the search cost. Okay, now based on this logic, Diamond shows that the only price equilibrium with rational expectations is completely the opposite than what we had before. Diamond shows that the equilibrium is such that P1 is equal to P2 is equal to the maximum price, 100, that consumers are willing to pay. Here the intuition is that firms have an incentive to overcut. Before, they wanted to set a price below the price of the other firm in order to attract consumers. Here, using the logic that I just explained, the firms are willing to set a price above the price of the other firm because the search cost and the fact that consumers know only one price allows them to do that without losing any demand. I will explain this more on the next slide, but first of all, let us note that the total absence of price transparency allows firms to behave as monopolists, which obviously hurts the consumers. We have the exact opposite conclusion as before. Now, with absence of price transparency, it's the firms that get the largest share of the cake, leaving nothing to the consumers. Okay, let us now explain why the unique equilibrium in this case is where prices are equal to the maximum price that consumers are willing to pay. So suppose that firm 2 is setting that price of 100, And also suppose that consumers expect that the two prices are equal to 100. So we need to start somewhere, and we assume that this is what the consumers expect. Okay, and this is what firm 2 is doing. Now, what is the best that firm 1 can do? We want to show that the best that firm 1 can do is to set a price equal to 100 as well. And if it does so, then consumers are rational in believing that the two prices are equal to 100. Okay, so why would firm 1 be willing to set a price of 100? Well, clearly it doesn't want to set a price higher than that, because this would be too large a price for consumers. Profits would go to zero. No consumer would buy at that price. Now, we would think that there is an incentive for firm 1 to lower its price. Okay, with the previous logic of the Bertrand model, lowering the price allows you to attract consumers. But the problem here is that the consumers who are not buying from you now are the consumers located near shop 2 who don't know your price. To discover your price, they would need to pay the search costs of 2. But why would they pay the search cost of 2 if they expect both prices to be equal to 100? There is nothing to gain to learn a price that you expect to be as large as the price that you already observe. Okay, so consumers of firm 2 are not willing to pay the search costs. Okay, so if firm 1 is setting a lower price, firm 2's consumers are not going to know it. So firm 1 is not going to attract any new consumer. The only thing it will do is to lower the profit it makes on its captive consumers, those who can observe its price. And this is not worth it. Okay, so to cut a long story short, we have shown that the best for firm 1 is to set a price equal to 100, which confirms the initial expectations of the consumers. So we found a situation where the two firms are best responding to one another. Consumers make the optimal decision they can make in terms of buying and in terms of searching, and the anticipation they were making, the expectations they were having, are confirmed at equilibrium. So this is an equilibrium, and Diamond shows that there is no other one. If you were having two prices, P1 is equal to P2 is equal to something lower than 100, then by the previous logic, we understand that each firm would be willing to increase its price by less than 2 in order to increase the profit it makes on its captive consumers without losing them, without having them going to the other firm. Okay, so we have seen two extreme cases, the Bertrand model where all consumers were informed and were benefiting from the situation, and the opposite where all consumers were uninformed, and we saw there that it gave all the power to the firms. Now, more realistically, we would like to have a model where some consumers are informed and other consumers are not. One way to think about it would be to have 600 consumers who can observe both prices, and the rest, the 400 consumers, would, for half of them, observe on just P1 and the other half observe just P2. And for now, assume that there is no search cost, or the search cost is prohibitively large. So consumers are uninformed and cannot become informed. Now, to understand what happens, we need to combine the two intuitions we had from the previous models. From the Bertrand model, we know that firms are willing to undercut. They want to attract the informed consumers by having a lower price than the rival. Okay, but at the same time, they also want to somehow exploit their uninformed consumers, those consumers who just know their price and are going to buy just from them, and not from the other firm. Okay, so one way to think about the conflicting incentives that the firms have is to think of this picture. So think of this level here being 100, the largest price that consumers are willing to pay, which is also the price that a firm would set to exploit fully its captive consumers. Now, you want to go down the stairs in order to attract the informed consumers, because those consumers compare the two prices and you can only attract them by being cheaper than the rival. Obviously, the rival wants to do the same, and so you go down the stairs, both of you. But at some point, you reach a place where you don't want to go further down, because you would reach the kind of secure profit you can make by just concentrating on your captive consumers. And if you reach that floor, well, you just take the elevator to go back to the top level. Okay, so let's just try to see this in numbers. To get the informed consumers, you want to decrease the price. Okay, the profit you would make if you are the cheapest firm, you would sell to you 200 captive consumers. You would also attract the 600 informed consumers. You would make a margin of P1 minus 20, and this is so as long as PI is less than PJ. Now, that would be being competitive. Now, you also know that there is a guaranteed profit you can make, in the sense that you just concentrate on your 200 consumers, you set the largest price they're willing to accept. Obviously, you face the cost per unit of 20, but if you do so, you're guaranteed a profit of 16,000. Now, you don't want to go below that. So the maximum or the minimum, I would say, PI that you're willing to set is such that you can have a profit larger than this. Okay, so this is the condition here. The profit you make in this case, 800 times PI minus 20, has to be larger than 16,000, which, if you do the math, means that PI has to be larger than 40. You will not go below 40. 40 is actually the floor here. If you reach that, well, you go up the elevator and you prefer to be on the top, setting a price of 100. Okay, so we've just seen that firms want to go down the stairs, but at some point they want to go up with the elevator. How do these two forces balance one another? Well, one way to think about this is to assume that the two firms set prices in a sequence. Say that firm 1 sets P1 before firm 2 sets P2. Okay? Well, in that case, Steven Salop and Joseph Stiglitz have shown that there exists an equilibrium with P1 is equal to 40 and P2 is equal to 100. Okay, so firm 1, setting the price first, would set a sufficiently low price to attract both types of consumers, its own uninformed consumers, and all the informed consumers. And observing this, firm 2 will prefer to concentrate on its uninformed consumers. At equilibrium, both firms, you can check, make the same profit of 1600. Now, why is this an equilibrium? We'll start with the last part of the game, where firm 2 has to decide its price, while firm 2 observes that firm 1 has set a price of 40. Then firm 2 thinks, well, if I want to attract the informed consumers, I would have to set a price lower than 40. But if I do, well, I will make a profit less than 16,000. And remember, 16,000 is the profit that each firm can secure by setting a price of 100 and serving only its 200 captive consumers. Okay, so there is it's not worth for firm 2 to lower the price below 40, and so while having a larger price, it's better to set it at the largest possible level, which is 100. Okay, so it's perfectly rational for firm 2 to set a price of 100 if it observes that firm 1 has set a price of 40. Now, move back to the first period when firm 1 has to decide. Well, firm 1 anticipates that by setting a price of 40, firm 2 will not try to get the informed consumers and will later on set a price of 100. If firm 1 sets a price larger than 40, then it will be profitable for firm 2 to set a price below 40. Okay, so firm 1 cannot do better by setting a price above 40, and setting a price below 40 is not worth either for the reasons that we have explained. Okay, so what they show here is that because there is partial transparency of prices, in the sense of some consumers observing both prices, but other consumers observing only one price, because of that, the equilibrium may exhibit what is called spatial price dispersion. Price dispersion means that two firms set different prices for the same product. And spatial because it appears at the same point in time. So if we think again of two firms located at different places, well, one firm has a low price while the other firm has a high price. Okay, and the firm with a low price is serving its own consumers, but also the informed consumers, while the firm with a high price is only selling to its own captive consumers. Okay, so here both firms make a profit, but they compete with one another for the informed consumers. And if you compare with the previous model, the diamond paradox, the profits that the firms make at equilibrium is lower than what they would make if all consumers were uninformed. But also they make a profit which is higher than the one they would make in the Bertrand model, where all consumers are informed. Okay. Now, if we come back to the assumption that prices are set at exactly the same time, so simultaneously, then the two forces going down the steps and up the elevator are never really balanced. It's as if the two firms were chasing one another all the time and changing their prices all the time. So to make things simple, in the jargon of game theory, it means that there is no equilibrium in pure strategies. Firms, you cannot find a stable situation or stable pair of prices such that both firms are best responding to one another. Okay, so we need to define the equilibrium in terms of mixed strategies. What does that mean? It means here that both firms will choose a probability distribution on some interval. They will draw a price between the two extremes that we have examined before. The price of 40 is the price under which they don't want to go, and the price of 100 is the price above which there is no reason to go. Okay, so firms will choose a price randomly in this interval 40 to 100. Now, it can seem weird that firms randomize prices, but actually it makes sense because it both confuses consumers and the competitors. Consumers have a hard time to learn which firm is the cheapest, so that reduces their incentive to search, and if there are fewer informed consumers, then competition will be lower and profits will be higher. Also, confusing competitors is useful because it's harder to compute the optimal price that should be set to attract the informed consumers. So that also reduces the competition and leads to higher profits. So the result is not very different from what we had before. We just say here that we have what is called temporal price dispersion because everything takes place at the same time. So through time, we should say, the prices that the firm set can be different from one another, but also from one period to the next. Okay, so there is price dispersion in the presence of partial transparency of prices. If there is a sequence of price, that was the previous slide, the price dispersion is called spatial. If prices are set simultaneously, we observe temporal price dispersion. Okay, now quickly a few words about what happens if there is imperfect information on the seller side. So now we assume that consumers can observe both prices, but we question the possibility for firms to observe price changes. Okay, we have in mind an infinite repetition of the Bertrand model. So in each period, firms are setting P1 and P2, and they do this again and again without any potential end to this process. So it's always possible that they will again set their prices. Now, you probably remember the story of tacit collusion, which I will not detail here. You can read the slide. But remember that the story is based on the idea that firms may be setting a high price, here 100, in every period, because they fear that if they deviate, if they set a different price, then the other firm is going to punish them by setting a price equal to marginal cost for all the periods to come. So firms will balance what they can gain by deviating now and attracting all the consumers with what they would lose in the future by making zero profits forever. Okay, and if you remember the story, it says that if firms put sufficient weight on the future, so if they discount the future not too much, then they fear this potential punishment, and because of that, they prefer to keep high prices in every period, which amounts to a situation of collusion, okay, and which of course is hurting the consumers. Now, this reasoning is based on the assumption that as soon as one firm deviates, the other firm will observe this and will immediately punish, so set a low price in order to punish the other firm. Okay? Now, what happens if firms cannot observe as easily the price changes of the other firm? Well, then they may hesitate before they start punishing. I mean, it may be that the price decrease they observe is not due to a deviation of the other firm. It may be due to a sudden decrease in demand or whatever reason you can think of. So they may hesitate. It may be costly for them actually to start the punishment, and so they may refrain from doing it. But if they do, the threat of being punished is lower, and so the incentive to deviate by setting lower prices becomes higher. To cut a long story short, if the observability of prices is not as good, tacit collusion is harder to sustain. Which is to say, in the opposite, if firms can observe prices very easily, tacit collusion is easier to sustain. And so the potential for firms to raise prices above the marginal cost and potentially up to the monopoly level, this possibility becomes more likely. Okay, so this is what is summarized here. The transparency of prices allows firms to detect more easily the price changes of their competitors. This makes it easier for firms to sustain higher prices through time, thanks to a mechanism of tacit collusion based on punishment threats. Okay, so let's wrap it up. What are the main takeaways of what we have seen in this presentation? Well, first of all, if buyers can observe prices better, this will induce more competition on the market, which will raise consumer surplus and lower the firm's profits. But if sellers can also observe prices better, then the likelihood of tacit collusion is larger, meaning that firms would be able to set higher prices, which increases their profits and lower the consumer surplus. Finally, we have learned that if there is imperfect observability of prices by the buyers, with some buyers being able to observe all prices, but other buyers being able to observe just one price, well, in that case, we can have at equilibrium what is called price dispersion. Different firms set different prices for the same product. Thank you for your attention.